Hi everyone, today we'll be going over accounts October-November 2020, paper 3-1, question number 2. This is structured paper 3, which consists 6 questions, each of 25 marks, and we are also given a time limit of 3 hours. So we will be attempting to solve each question under 30 minutes. And this question number 2 is a part of section A, which relates with financial accounting. So without any further delay, let's get started. PL PLC is a trading company. A trainee in the finance department made a start on preparing the financial statements for the year ended 31st December 2019. He produced the following statement, which contains errors. Okay, so we're given the statement of changes in equity for the year ended 31st December 2019. And okay, there are tons of errors. So we're given the opening balance at 1st January 2019. And this is correct, there are no issue here. Then secondly, we're given the issue of new ordinary shares at 2.50 each, whereas we're given that our ordinary share capital has a nominal rate of 1 each. So this price or this value is based on 2.50. So rather than this value, this should only contain the number of shares multiplied with our nominal rate, which is $1, right? So let's figure out the correct value to be included in our ordinary share capital. Suppose that our number of shares is n. Then n times 2.50, which is the rate being used right here, this gives the value of 150,000, right? So that's 150,000. So we can now easily figure out the actual number. So that's just 150,000 divided by 2.50, which results in the value of 60,000. So we can say that we actually issued 60,000 ordinary shares at the rate of 2.50. But instead of including all value in the ordinary share, we should also include the value in our share premium. So I'm just going to create that column right here. Okay, then in the ordinary share capital, it should only contain $1 rate. So that's just going to be 60,000 times 1, which results in the value of 60,000 again. So instead of including 150,000, the value which should have been included is 60,000. Okay, then the remaining value should be included in the share premium. So remaining value is just the difference between 150,000 and 60,000. So this gives our value in the share premium to be 90,000. So let's include it. That's 90,000. All right. Then we're given dividend paid, but this is subtracted from our ordinary share capital, which is incorrect. Dividend paid should be subtracted from our retained earnings. So this 20,000 should be on this column. All right. Then 1 for 10 bonus issue of ordinary shares. So whenever we're issuing ordinary shares, this definitely increases the balance on our ordinary share capital. But we can see here that it is actually decreasing our ordinary share capital. So this is incorrect treatment, right? So rather than subtracting the 31,000, we should add the 31,000. And since this is a bonus issue, this should be funded from within the company itself. And we already have the balance on share premium, which can sustain the amount of 31,000. So we're actually transferring the 31,000 from share premium to our ordinary share capital. So this definitely reduces the balance on our share premium. Okay, then we have a bank loan received, which is entered correctly into our bank loans column. Then we are given profits from operations, which is being added to our retained earnings. But we know that rather than the profit from operations, we actually include our profit for the year. So let me just correct this. So profit for the year should be added. And we actually need to figure it out. So I'm just going to do it right here. We know that profit for the year is just going to be our profit from operations minus the finance charges. Okay, and we are given our profit from operations to be 63,000. Let's write it down. And finance charges are basically the interest charges, right? So let's have a look above. We can see that loan interest paid was 12,000. Okay, then let's have a look at our additional information. We're told that premises had been revalued and a general reserve had been created. Okay, that has nothing to do with our finance charges. Then on the third point, we can see that we're given information regarding accrued interest. And accrued interest amounted to 3,000 on 1st January 2019 and 5,000 on 31st December 2019. Okay, so we need to adjust this as well, right? So what we know is that we paid 12,000 in this particular year, right? Which is the information given right here. And we know that accrued interest on our opening date was 3,000. So this is just the amount yet to be paid for the previous year, right? So this should not be included in this particular year since this relates to previous year. So we are just going to subtract that 3,000. And then we have the accrued interest amounting to 5,000 on our closing date, which is 31st December 2019. And this just means that this is the interest yet to be paid, which actually relates to this particular year. And this should definitely be included in the interest charge or the finance charge for this year, right? So I'm just going to add that 5,000. Now this gives our total finance charges to be 12,000 minus 3,000 plus 5,000, which results in the value of 14,000. Now we can substitute this value into our formula for profit for the year. So that's minus 14,000, which is the finance charges. Now this gives our profit for the year to be 63,000 minus 14,000, which results in the value of 49,000. So instead of including our profit from operations of 63,000 from the retained earnings column, we actually need to include this value of profit for the year. Let's correct it. So instead of 63,000, there should be the profit for the year of 49,000. Okay, then we were told that premises had been revalued from 100,000 to 195,000. So this is revaluation upwards, right? So we also need to create a revaluation reserve. And this will have the difference between these two values. So that's going to be 195,000 minus 100,000, which results in the value of 95,000. So we can say that our premises had been revalued upward by 95,000, which means that our revaluation reserve will also contain the value of 95,000. Okay, then lastly, we were also given information regarding general reserve. It had been created amounting to 30,000. So what we know is that whenever we create general reserve, we actually put in the money from our retained earnings. So if we are creating a general reserve, we need to transfer the value from our retained earnings section to the general reserve. So if we're adding 30,000 to general reserve, we definitely have to deduct 30,000 from the retained earnings, right? So this will be general reserve, and this will now have the value of 30,000. Okay, this is the closing value for general reserve. This is the closing value for revaluation reserve. Let's figure out the closing value for share premium. That's going to be 90,000 minus 31,000, which results in the value of 59,000. Then let's figure out the total for retained earnings. That's going to be 76,000 minus 20,000 plus 49,000 minus 30,000, which results in the value of 75,000. So rather than the value of 170,000, it is 75,000. Okay, and then for ordinary share capital, that's going to be 250,000 plus 60,000 plus 31,000, which results in the value of 341,000 rather than 349,000. Okay, so this should be our correct statement of changes in equity for the year ended 31st December 2019. Alright, then the additional information given is that trade payables at the year end were 67,000. And we are told that it is the policy of the company to keep its reserves in the most flexible form, like we did above. When there was a bonus issue of shares, we actually funded the bonus issue from our share premium. So that is keeping the reserves in the most flexible form. And then of the original bank loan, 20,000 is due to be repaid during 2020. So we know that our current year is 2019. And if we need to pay this 20,000 in the year 2020, then this is a liability that needs to be repaid within a particular year, which means that this now will be included in our current liabilities rather than the non-current liabilities. Okay, and the remainder due in the following years. So remainder will still be the non-current liabilities. Okay, now let's move to our first question. For the first part, we need to calculate the profit for the year ended 31st December 2019, which we already did. So we just need to copy this entire thing for our solution. Let's write it down. So what we know is profit for the year is just the difference between profit from operations and finance charges. Let's have a look above. So we substituted this value of profit from operations from the incorrect statement of financial position, and we figured out this finance charges by adjusting our accrual values, right? So let's substitute this value of 63,000 and 14,000 for profit from operations and finance charges respectively. That is 63,000 and 14,000. So this gives our profit for the year to be 63,000 minus 14,000, which results in the value of 49,000. This concludes the first part of this question. Now we can move towards the second one. We need to prepare the correct equity and liabilities section of the statement of financial position at 31st December 2019. Okay, we know that we are producing the statement of financial position for PL PLC. And this is statement of financial position. And we know that this is only an extract. And our financial position is at the date of 31st December 2019. Okay, so let's start with our equity section. Let's have a look above. So in our equity, we need to include our ordinary share capital, share premium. Then we had the revaluation reserve. And we also have general reserve. And then finally, we have our retained earnings. So there are 5 headings to be included under equity section. Let's write it down. The first one is ordinary share capital. Then we have the share premium. Then we have revaluation reserve. And we also have general reserve. And the last one was retained earnings. Okay, now let's have a look above to figure out its values. So the total of ordinary share capital, or the balance at 31st December 2019, was 341,000. Let's write it down. That's 341,000. Let's have a look above for share premium. We can see that the total for share premium is 59,000. Let's substitute this value. Let's have a look above for revaluation reserve. And we figured out that the revaluation reserve had the value of 95,000 and general reserve had the value of 30,000. So let's write these values. That's 95,000 for revaluation reserve and 30,000 for general reserve. Then let's have a look above for retained earnings. And the total for retained earnings, we figured it out to be 75,000. Let's substitute this value as well. So that's 75,000. Okay, now we can easily figure out our total equity. That is just going to be the sum of these 5 amounts, which is 341,000 plus 59,000 plus 95,000 plus 30,000 plus 75,000, which results in the value of 600,000. Now we can move towards the non-current liabilities section. Okay, let's have a look above. We can see that the only non-current liability that we have is of a bank loan, and the balance of the bank loan at 1st January 2019 was 80,000, and then we received a new 5-year bank loan of 25,000, so we need to add it. That's 80,000 plus 25,000, and we are also given additional information stating that 20% of the bank loan is due to be repaid during 2020, which makes it a current liability. So we need to exclude it from our non-current liabilities, right? Let's subtract the 20,000. So this gives our total bank loan to be 80,000 plus 25,000 minus 20,000, which results in the value of 85,000. Let's write it down. So that's bank loan of 85,000. And this concludes the non-current liabilities section. So now we can move towards the current liabilities section. Okay, let's have a look above. We are given information regarding trade payables. Trade payables at the year end were 67,000. So let's record this value. That's trade payables of 67,000. Let's have a look above. Then this 20,000 of the bank loan is a current liability now. So let's record it as well. That's bank loan of 20,000. Okay, then we had accrued interest as well, meaning that this 5,000 is an accrued interest on 31st December 2020, which means that this is interest yet to be paid, and this amount needs to be paid within next year, right? So this is other payables. Let's write this amount of 5,000 as well. So that's other payables amounting to 5,000. Now we can easily figure out the total for our current liabilities. That's the sum of these three values, 67,000 plus 20,000 plus 5,000, which results in the value of 92,000. And now we can easily figure out our total equity and liabilities. That is just going to be the sum of our equity, non-current liabilities, and current liabilities. So that's going to be 600,000 plus 85,000 plus 92,000, which results in the value of 777,000. Okay, so this concludes our extract from Statement of Financial Position as well as the second part of this question. Now we can move towards the third one. Okay, we are given the working section. So instead of scribbling all over the question paper like I did, you guys should be showing all of your workings in this particular box. We are given additional information. The financial statements of PL PLC also contain a value for goodwill. Now we need to explain the event which has taken place and caused the company to record the value for goodwill. So the very first event that could possibly take place and give rise to a goodwill in the statement of financial position is that the company should purchase another business, and then while paying for the business we give an amount called purchase consideration, right? That amount will definitely include a goodwill that we are giving in order to purchase their business, and this allows us to include that goodwill value into our statement of financial position. So let's write it down. The company has purchased another business as a going concern and paid a purchase consideration higher than the value of the net assets. Net assets is just the difference between the assets and liabilities taken over. Alright, this concludes the third part of this question. Now we can move towards the fourth one. We need to state two other reasons why goodwill might arise. So the very first reason for goodwill would be a good reputation of business. Let's write it down. And secondly, it could be good customer base as well, because if your customer is speaking good things about you, then that definitely increases your reputation among the customer base, right? Let's write it down. Good customer base. Okay, now this concludes the fourth part of this question. Now we can move towards the fifth one. We need to explain what is meant by the term audit. So audit is just the process of independent check of a business's accounting records and their financial statements done by an independent qualified person. So this is done to check for any kind of errors and to check whether the accounting procedures and financial statements is in compliance with the accounting standards and the relevant laws and rules of that particular country, right? And that will result in a report stating whether or not the financial statements actually give a true and fair view of the business or not. So let's write it down. An independent check on a business's accounting records by an independent qualified person to check for material errors and to check compliance with accounting standards and relevant legislation resulting in a report stating whether or not the financial statements give a true and fair view. Okay, so this concludes the fifth part of this question as well as this entire question. If you found this video useful, make sure you like the video and leave a comment below, and make sure you're subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.